This is a demonstration of using a worksheet to adjust financial statements for error corrections. And this is an example that was given in your textbook, and I'm going to work it on a spreadsheet so that I can help you to understand how to make the corrections for these errors. So what we have for Dick and Wally's outlet is an unadjusted trial balance for the year 2021. And then we have columns for our adjusted income statement and balance sheet. We have two columns here to make the adjusting entries as we go through and analyze each of these error situations. And after we get through, the spreadsheet is going to automatically update both the balance sheet and the income statement amounts so that at the end you would be ready to do your financial statements. So we're going to look at this, and remember we're in the year 2021, so we're at the end of the year, but our books for 2021 are not closed. However, we will be making adjusting entries also for 2020, and we will see those books are closed, so we will have to make those adjusting entries to retained earnings. Okay, so let's get started. In the first one, it states that the bookkeeper inadvertently failed to record cash receipts of $1,000 on merchandise in 2021. So this is in the current period, and the books are not closed. So when that happens, all you have to do is just make the entry that you would normally make. So we would debit cash for $1,000. We would scroll down and we would credit sales revenue for $1,000. So we're making those adjusting entries, and the spreadsheet is updating. Okay, in number 2, it states that we had accrued wages expense at the end of 2020 of $2,500, and at the end of 2021, $3,200. The company does not accrue for wages, and all wages are charged to administrative expense. So the company has not been making adjusting entries at the end of the year for any accrued wages. They are just paying and debiting their expense account, administrative expense, when the wages are paid. So first we're going to look at the entry to correct the entry for 2020. Those books are closed. So those expenses of $2,500 would actually have been debited to administrative expense in 2021. Okay, so we've closed the books for 2020, so we're going to have to debit retained earnings for that $2,500 because that belonged in the prior year. And we want to credit our administrative expense for this year for $2,500 because it has those expenses that actually belonged to 2020 in this year. Okay, so that will correct the error for 2020. Now we're going to look at the entry to record for 2021. Because the books are not closed, we can go ahead and just make a normal adjusting entry. We would debit administrative expense for $3,200, and we would just credit salaries payable for $3,200. So we'll go ahead and go over to our spreadsheet. We will debit retained earnings for $2,500, and then we're going to debit administrative expense, and I've actually netted these two amounts, $3,200 minus $2,500, to get a net debit of $700, and then we're going to credit salaries payable for $3,200, and that will make the correcting entries for both years. Okay, so now we're going to look at number 3. It states in number 3 that the company had not set up an allowance for estimated uncollectible receivables. Dick and Wally decided to set up such an allowance for estimated probable losses as of 12/31/21 for the 2020 accounts of $700 and for 2021 accounts of $1,500. They also decided to correct the charge against each year so that it would show the losses, actual and estimated, relating to that year's sales. The company has written off accounts to bad debt expense, selling expense as follows. And I believe that the textbook gives us this information, what we've actually written off in 2020 and 2021. So the company has been using the direct write-off method instead of the allowance method. They want to begin using the allowance method this year, but they also want to correct for not having used the allowance method in 2020. Okay? So the first thing we're going to look at is, what have we done with 2020? Or what should we have done? Okay, so in 2020 we did debit selling expense for $400 for sales for that year. In 2021, though, this year we debited selling expense again for $2,000 for expenses that really belong to 2020, and we estimate that there will be an additional $700 of selling expense for bad debts in 2022. So what should we really have done? We really should have debited selling expense in 2020 for $3,100 total and credited the allowance account. Okay, but those books now are closed. The only amount that was actually debited to selling expense correctly was that $400 that we actually did do in 2020. So the net amount, $2,700, would need to be debited to retained earnings, and that will correct retained earnings for the for that error for 2020. Now we are in 2021. We have not closed the books for it. We have debited selling expense this year for $1,600 of 2021 sales, but we've also debited it for $2,000 that belonged to 2020. So we've debited it this year for a total of $3,600. Now, what should we have had in selling expense this year? Well, we should have had the $1,600 that we wrote off, and we should also have an additional $1,500 for the amount that we anticipate or estimate writing off next year. So this year we actually should have debited selling expense for $3,100 and credited the allowance account for $3,100. But because of that $2,000 from 2020 sales, we've actually got $3,600 in selling expense right now for bad debts. So that is $500 more than we actually needed. So we're going to have to credit our selling expense to remove that $500. Now there's still one part of the entry that we need to make, and that is we need to set up that allowance account for the amounts that we estimate that will be written off in 2022, which is $2,200. So if you look now at our entry, you will see that we will be debiting retained earnings for $2,700, crediting selling expense for $500, and crediting the allowance account for $2,200. So we're going to go ahead and make that entry. We're going to debit retained earnings for $2,700. We're going to credit our selling expense for the $500, and we're going to credit our allowance for doubtful accounts for the $2,200, and that will correct for the using the direct write-off method rather than the allowance method. Now let's look at number 4. It states in number 4 that prepaid insurance was not recorded at the end of 2020 for $600 and at the end of 2021 for $400. All insurance is charged to administrative expense. So what they've been doing is when they get a bill for their insurance, they just go right on and debit administrative expense for the whole amount and credit cash. What they needed to be doing is backing out the amount that's not for that year, but for the following year by making an adjustment to debit prepaid insurance and credit the administrative expense for the portion that belongs to the following year. Okay, so we're going to first correct the one that was recorded incorrectly for 2020, and remember those books are closed. Okay, so that $600 of prepaid insurance actually belonged to this year. Okay, so to correct it, we need to go ahead and debit administrative expense for $600 for this year. But we need to credit retained earnings for $600 because it was recorded, wasn't backed out or adjusted in 2020. Okay, that will correct that amount. Now for 2021, remember we've already debited administrative expense for the $400 because when we paid it, that's what we do. But that $400 belongs in 2022. So we can correct that by just going ahead and making the adjusting entry to debit prepaid insurance and credit administrative expense for $400. Now I did not net these amounts when I made this adjusting entry. I'm just going to make the entry separately. So to correct 2020, we would debit administrative expense for $600 and we would credit retained earnings for $600. To correct it for 2021, we're going to debit our prepaid insurance for $400 and we're going to come down here and credit the administrative expense for $400. And that will correct the prepaid insurance. Now the next entry, it states accounts payable of $600 should have been reported as a note payable. So this is just a reclassification entry on the balance sheet. So we're going to go to accounts payable and debit it to remove the $6,000, and we're going to go to notes payable and credit it for $6,000. Okay, the next one, it states that during 2020 the company sold for $7,000 an asset that cost $10,000 and had a book value of $4,000. At the time of the sale, cash was debited and miscellaneous income was credited for $7,000. So that was in error. We know that when a piece of equipment is sold, we need to remove it from our books. How do we remove it? Well, we debit the accumulated depreciation and we credit the cost. Okay, we know the cost was $10,000. They told us that the book value was $4,000. So if we can back into the amount of accumulated depreciation, must have been $6,000 because equipment minus accumulated depreciation would equal the book value. Now, there was a gain on the sale. We know that because it was sold for $7,000 and the book value was $4,000. So if the entry had been made correctly, retained earnings would have been credited, or gain on sale of equipment would have been credited for $3,000, and that would have been closed to retained earnings. Because remember, this happened in 2020 and the books are closed. However, retained earnings was actually that miscellaneous income was actually credited for $7,000, so retained earnings is overstated by $4,000. So we're going to have to debit retained earnings for $4,000. So let's make this entry. First, we're going to debit the accumulated depreciation for $6,000, and we're going to credit the property, plant, and equipment for $10,000, and then we're going to go down to retained earnings and take out that $4,000 that was too much. Okay, now we find that this created another problem, as it often does, because the equipment did not get removed from the books. We continued to depreciate it. And so we debit depreciation expense to administrative expense, and we did that for $800 in 2020, and we did it again this year in 2021 for $1,200. So remember, when we recorded it, we would have debited administrative expense and credited accumulated depreciation. Okay, so we've got to back out that accumulated depreciation for 2020 for $800, but since those books are closed, we're going to credit retained earnings for $800 because retained earnings was understated by that depreciation expense. That's the 2020 portion. Now for this year, again, we need to back out the $1,200 of accumulated depreciation that shouldn't have been recorded, but our books are still open for this year, so we can credit administrative expense for the $1,200 for 2021. Now to correct this, I did make one entry. I added up both of my accumulated depreciation amounts to get $2,000 debited to accumulated depreciation. Then we're going to credit retained earnings for $800 and credit administrative expense for $1,200. So we're going to go ahead now and make that entry. Debit accumulated depreciation for $2,000. Then we're going to credit our retained earnings for the $800 for 2020 and credit administrative expense for $1,200 for the depreciation recorded in error this year. And that is the last of our adjusting entries, and you can see that our debits and credits equal. These have all been updating our balance sheet amounts to where the balance sheet is now corrected, and we have corrected our sales revenue as well as the accounts that were affected in our expenses, and now we have the correct amount of net income. So we're ready to do our income statement and our balance sheet. And that is the conclusion of the demonstration of the worksheet analysis to adjust the financial statement.